You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube and SoundCloud. Subscribe to stay informed. Hello and welcome to the Goldnomics podcast, where we look at global markets through the lens of precious metals. And you can keep your eye out for new episodes on iTunes, on SoundCloud and also on YouTube. And you can like us on Facebook, follow us on Twitter. And we have so far in this series of podcasts, we looked at 2018 and what developments we can expect in the global financial markets for 2018. And then in our last episode, we asked the question, is this the greatest stock market bubble in history? And this month, we're asking the question, is the gold price going to hit $10,000? And as usual, I'm joined by Stephen Flood, CEO of GoldCore, and Director of Research and well-known precious metals commentator Mark O'Byrne. Gentlemen, welcome once again.
Hi, everybody.
Hey, it's great to be here.
Now, is the gold price going to $10,000? $10,000, Mark? Really?
Yeah. Who knows? I don't know. You don't know. Steve doesn't know. Nobody knows, and nobody can predict the future. And that's always our first, point that we always make. You know, we cannot predict the future. We cannot predict the future price of any asset. But generally, over time, assets tend to appreciate, not because they're appreciating per se, but because fiat currencies are losing value over time. So, I mean, that's the first sort of core point that has to be made. But I suppose when forced to make calls on these markets, which sometimes we are, we take part in the Bloomberg Gold Survey, we take part in the Reuters Precious Metals Poll, and we're polled about the outlook for these prices. And we have a fairly good track record in this regard over the years, you know. So when we look at that, I mean, you have to be bullish in the world we live in today. And in terms of, we looked in the previous podcast, the everything bubble and the stock market and the overvaluation we see both in stock markets and bond markets. You know, I think in that context and a lot of other factors, particularly geopolitical factors, I think the outlook for gold is as bullish as it has been a long time, possibly as bullish as it was in the early 2000s. So, yeah, I think we're both of a view that it's going higher, and the question is how high and over what time frame, really.
Right. So what time frame are we looking at here, do you reckon?
Next hour or so? Who knows?
Depending on what Trump tweets.
Steve, I'll drag you in on this here. So do you see it going to $10,000 net?
Yeah, no doubt. And the time frame, it obviously is very difficult to pin down. Short term, you've got, you know, the futures markets playing a huge role, you know, setting the gold price. You know, the paper gold market chasing the physical gold market. It's like the tail wagging the dog. So short term, I don't know where it's going to be, but I do think the long term fundamentals are very supportive of higher gold prices, i.e. lower currency values. We're in a world where currencies are competitively being devalued. They're being printed. You know, politicians and central banks are paying the bills of today with the money of tomorrow, and they're impoverishing savers and pensioners in the process. So, you know, everything that's physical, everything that's tangible, and gold is one of those, its monetary price is going to rise with that backdrop.
Right, okay. And I suppose to give a bit of a framework on this, we probably have to look at it through a number of different angles. I mean, geopolitics is probably one of the key drivers for this, isn't it? Would you agree on that?
Yeah, be one of them. I think the monetary aspects would be bigger, and monetary policy and the scale of quantitative easing we've seen, and just the destruction of the central bank balance sheets, you know, that's probably a bigger factor. We have to tend to look at it through the lens of four key factors. One is the monetary side of things. The other one is geopolitics. Then there's the systemic side of things, MSGM, and then there's the macro. So the macro is the wider economy, and whether we're going to have a recessions or depressions or booms or busts, and do we have inflation or deflation? So the wider macroeconomic backdrop. So they're like the four fundamentals that you need to evaluate the market. And I think if you look at those four fundamentals, you know, they all, and sorry, the final thing then is actual supply demand in the gold market, and all those factors drive the supply and demand in the gold market. So
let's take that one then from the top. So we're looking at monetary policy primarily as your key driver, do you think?
Yeah, I would think so. Yeah, and oftentimes it has to react to these other factors, you know. But I think it's the prime mover over the medium and long term.
And monetary policy and quantitative easing is something that we've mentioned in the last two podcasts. But just in case our listeners haven't listened to either of those podcasts, and I would recommend you going back and finding them and having a listen. They're very good content in both of those. Give me a 30-second explanation just of the quantitative easing and the monetary policy impacts on the gold price, and we kind of expand on it from there.
30 seconds. It's ambitious. I mean, yeah, basically the central banks have printed a huge amount of money and increased the debt load. The debt has in effect been transferred from the private sector to the public sector, and yeah, the debt has just gone. It's gone pretty much parabolic. I mean, when you look at the charts, it's incredible. When you look at and we covered the debt to GDP ratio in the US. In most Western economies, and indeed at a global level now, the global debt to GDP ratio is up over 300%. So debt is going up very sharply. In terms of it's nearly a straight line up at this stage. Whereas GDP seems to be evening out. And we're not getting before when you increase debt, you would get a leverage return on the increase in debt, whereas now they're not getting that return, and so it just makes the economies very, very vulnerable. And Jim Rickards puts it well. He talks about 1998, Wall Street bailed out a hedge fund, LTCM, the biggest hedge fund in the world. And then 2008, Wall Street got bailed out by the central banks. But now the central banks' balance sheets are massively impaired, and they're potentially in big difficulty against another crisis, which seems inevitable. It seems to be the question of when rather than if. So the question then is, well, who's going to bail out the central banks? Who's going to bail out the system the next time? And
the IMF.
Yeah, the hope is the IMF, but I'm not so sure how that's going to work out.
Or in other words, you and me, the little people. We are the lender of last resort in this entire construct.
What form does that take? How do you and I become the lender of last resort?
Well, we're going to pay more in taxes. We're going to have to work harder for less. Our savings and our pensions are going to be levied.
And bail-ins as well.
And bail-ins.
Bail-ins now as opposed to bailouts. So just explain the difference now for our listeners there.
Exactly. Well, in the so-called bailouts, the taxpayers, governments basically went and took money from the taxpayers in the form of higher taxes and pension levies to bail out the banks. And now the narrative has changed whereby we are not going to take money off the taxpayers, we're going to take the money off the depositors. And as the so-called creditors who have been protected heretofore, and the narrative is, we're so good now, we're looking after the taxpayers, and we're just going to hit the creditors. They're going to have a haircut rather than the taxpayer. But the biggest taxpayers in society are SMEs and business people and the people who create wealth and create jobs in our economies. And if you go and take their capital away in the form of taking their deposits, it's going to have a hugely deflationary impact. So it's a really big issue that we cover quite frequently, because we covered it even just this week in the market update. Because you look at the Italian banks, you look at the various European economies and the level of debt in all these European economies, including here in Ireland, and there are real risks in that regard.
If I could come in there, corporates will be hit. They're the ones who are very unprepared in this eventuality. So if there is a bail-in of your high street bank, it'll be sold to the people en masse saying, hey, listen, only those people over 100,000 are going to be tapped to pay this bill. But those people include entities which are corporates, and those corporates will be tapped as well. And
what's the knock-on effect of that? Because people listening are going to say, as long as it's corporates and it's not me, that's okay.
Who do the little guys work for? They're the SMEs. They're the people who actually keep the lights on and keep money moving around the economy and keep people jobs and pay mortgages through their employees. So they're going to be hit up. They're going to have a massive haircut, and I don't know even how, if this has been planned out, how they're going to manage it all. So this is going to affect every single family in all of those major states that have totally unsustainable debts, and it's coming. I can absolutely say that it's going to happen at some point. You're going to see it. I don't know which economy first. It could be somewhere like Italy. It could be France. It could be Spain, Portugal, even Ireland. All of these economies are creaking under the burden of debt, and much of that debt has been hidden off balance sheet by the central banks, and it's going to come back onto the market at some point. We're going to see higher interest rates, and when that happens, then that debt becomes very much unsustainable. Even at the rates that use, some of the ratios you see in banks, they say, hey, we are safe. We have passed a stress test. We can manage in a difficult time, but I don't buy it. I think a lot of this debt is still there, and I think it's unmanageable.
So as good as money in the bank is no longer a good thing.
No, exactly. Yeah, it's what's the safest houses, and that is a big expression in Ireland regarding our property market. It's the safest houses, and we know what happened there. You know,
I was talking to a chap who works at a major bank in Europe, I'm going to say, and they were talking about their credit risk, and they said, "Listen, the bank is completely fine. We're as safe as houses," and then they'd all have a big laugh about it because they knew damn right well, what would happen to the house prices if interest rates go up.
Yeah, and that narrative of cash is king can become cash is trash very quickly, particularly when inflation ticks up, and just recent data in the US and UK, and particularly US and UK, there's the inflation pressures are building in quite a big way, and it looks quite stagflationary, which is the condition in the 1970s which saw gold prices go up 24 times. So, but just one last point on that, so cash is king can become cash is trash. And on the balance thing as well, people think that they have the government guarantee in each country, which is 100,000 euros, now 100,000 pounds. It used to be 250,000 pounds in the UK, and very quietly and surreptitiously that was reduced to 100,000 pounds there about a year.
75 now, isn't it? In keeping with the euro.
Oh, is it?
Yeah, it was actually dropped. Yeah, they did that again. Okay. Dropped it again.
Okay. So, I wouldn't be surprised. I must check that. But it was very quietly done. And the thing about that is people think, oh, well, I'm fine, up to 100,000. And what they do is if they've more than that, they'll put it into 2 or 3 different banks. But what would happen in that scenario is the governments will need to get a certain amount of money to bail out the banks, and therefore that guarantee could be reduced overnight with the stroke of a pen. So the 100,000 guarantee or 75,000 euro guarantee or whatever it is can come down to 50,000, 40,000.
It's just a figure of revenue that has to be raised.
Exactly.
And tell us, how does this then, this is going to drive the gold price, because effectively people will be taking the cash out of the banks and putting it into gold.
It'd be one of the factors that would drive it, yeah.
And is this widely held? Is there a wide understanding of this bail-ins issue at this moment in time, or do you think that there's still a lot of education to be done around this? People have no clue. The majority of people do not have any understanding whatsoever. It's rarely covered in the media, so people are not aware about this huge, just a lack of information in effect. I think people in our circles in the precious metals industry, tend to focus on these risks, and sometimes, we're accused of exaggerating them, but they're very real risk. I mean, we've done very in-depth research on this, and the research it cannot be argued with. The facts are all there. It's all laid out if you choose to look into the legislation. And
in Ireland, the bail-in tool, as the regulators called it, was brought in about 2 years ago. It was signed into law by the Minister for Finance at the time, and I was like, this is such a landmark piece of legislation. It came in through Europe through a regulation, the Bank Resolution Directive, and I did a search in our Parliament where our elected representatives, discussed the matters of the day. And I couldn't find one single reference to bail-in as being a point of discussion at all in the record. Yeah. It just came in. It was signed into law as a statutory instrument. No discussion in any local political level, and yet it has a massive impact on every man, woman, and child in this country. Yeah,
it was interesting. We got an email from a client this week talking about, I think a similar thing happened in Australia just in the last week or 2 weeks, that it was passed in the Australian Parliament, and again there was very little debate, and I want to look into it a little bit more in depth, and I think it's something that we might cover in the market update in the next week or 2 weeks. So
I would say though, when and we don't want to labour the bail-in point, but if you manage the treasury policy of a company, I think it's absolutely your duty to look into the risk that you have across institutions. Like banks do this themselves. They will look at the amount of money they have at risk across institutions. They have certain levels. I think now even SMEs need to do that with their reserves. They need to have that money, even it might be more difficult to manage. They need to have that money spread across as many banks as possible, as banks that are safe. And they need to look at the balance sheets of those banks and the lending practice. They need to look at where those banks are located, the safest jurisdictions, and they need to do this, today. There's no time to waste. We don't know when this will happen. It could happen in 10 years. It could happen next year. We don't know. But the fact is, the bail-in tools are there. The scene is set for higher interest rates. Debt burden is going to become difficult to manage, and we think that there's going to be, market events that will these treasury officials are going to have to answer for. And also for people, high net worths and people who manage their family's affairs, they also need to be more discerning as to where they bank.
Now, you raised a point there, and you said the scene is set for higher interest rates. Now, a number of people listening to this are going to think, right, okay, well, gold yield is 0. Okay, interest rates are going higher. Surely that's going to be bad for gold.
Yeah, that's very much the perception out there, and that's the narrative. And you see it frequently in the media saying rising interest rates is bearish for gold. But if you look at the history and you look at the data, interest rates rose continuously throughout the 1970s from below the 10-year US Treasury, 10-year bonds below 5% in 1970 to up above 15% in 79-80. And gold prices went up from $35 to $850 in those 9 years. So rising interest rates, they weren't negative for gold whatsoever. The same thing happened again more recently. Obviously, some people might say, oh, well, that's ancient history, we're a long way from the 1970s. Okay, fair enough. Well, let's look from 2003 to 2007. I think interest rates went from roughly 3.5% to 5.5%, and the gold price went up from $400 to $700, $800, So the narrative is incorrect. Rising interest rates are actually bearish, as you can imagine, for assets that are bought with debt and with leverage. So property would be particularly vulnerable to rising interest rates, obviously. Even stocks to an extent, because a lot of stocks are increasingly bought on margin. The wider economy is vulnerable to rising interest rates. Gold is the least vulnerable to rising interest rates. Where gold is vulnerable, there's always a degree of truth to these narratives. Where gold is vulnerable is towards the end of an interest rate tightening cycle when you get a real rate of return. So if interest rates rise for a long period of time and you get a decent rate of return over the actual inflation rate, then gold becomes vulnerable. And that's when I would be nervous about gold, and I would be very strongly telling clients it's time to reduce allocations to gold. I mean, we would always have a view that you should have a bedrock of financial insurance in your portfolio of maybe 5% of physical gold. But in that scenario whereby you are getting, you have a decent bank and you're getting a decent yield on your deposits, that's a good time to put some money into the bank and reduce allocations to gold,
Yeah, when interest rates are rising, it causes people to rotate from one investment strategy to another, and that creates volatility in the market, and that's the case for gold. So a changing interest rate cycle is very, very bullish for gold, whether it be falling or rising. When interest rates are high and static, that everything is steady, the market is doing okay, interest rates are high, people are getting a decent rate of return on their savings, then the argument for other type of investments that don't pay as high an interest rate decreases. And that's the same with stocks, because you have more risk and you have a fairly boring rate of return sometimes. If you have interest rates up around 5-6%, that's a fair return for the risk you're taking. So you buy bonds, you might go heavily into bonds, and gold doesn't look attractive. But if interest rates are rising to 5% quickly and then falling from 5%, that creates anxiety in the markets. That creates a need for risk mitigation and the argument for gold. So it's not so much high interest rates, but high steady interest rates, and I don't think we're there, and we haven't been there for a while. So I think that's the counter argument.
What about the quantitative easing issue?
Yeah, I mean, like obviously you might say the rug is being pulled from under the market, because central bankers using their godlike powers are printing money, so they're changing the rules of the game to suit their own political purposes. Now they say they're not political, but they absolutely are, and they answer to political masters. In Europe on a national level. So when you print money, you're kind of you're inflating asset prices. You're selling a good story to the masses.
Artificially inflating.
Yeah, but it doesn't look that way to the masses, because it's happening fairly on a steady basis.
Because on one side you've got a stock market where it's very heavily publicised that the stock markets are increasing the whole time, but you don't hear about the increase in the amount of cash that's being printed and the correlation between the two, the connection between the two.
Absolutely, and there is a real correlation. If you look at the central bank balance sheets and the stock market, it's amazing the correlation there. And there was a correlation with gold up until 2011. And that's one of there's a variety of different ways that you can look at the gold price and say, right, well, what is fair value for gold price? And let's look at these different correlations and compare the ratios of different things. And one of those is the increase in the central bank's balance sheets. And it was going like 1-for-1 throughout the 2000s. And then more recently, 2011, obviously gold price fell very sharply, but the central bank balance sheets continued to increase very, very significantly.
And why did that relationship decouple then? Because obviously if we've had such printing of money over the last number of years, why have we not seen the gold price continue to rise significantly as it did back then?
Well, I mean, there's a number of reasons. One is that it had such a huge increase in the first place. I mean, it had gone from $250 in 2000 to $1,900 in August 2011. So, I mean, that's a big, big move. It was
up 10% per year, isn't it?
Yeah, exactly, and it's about 600% total return, over those 11 years.
On the 20-year basis, it's actually beaten most other asset classes, which, again, they don't talk about in the media.
Yeah, exactly. It's great research from PwC just a week or 2 weeks ago, publicised by the World Gold Council, and it should have got picked up more widely. And they basically, PwC, one of the biggest accountancy firms in the world, in an advisory piece for sovereign wealth funds, who are some of the, the wealthiest and the institutions with the most amount of money in the world, these sovereign wealth funds have been advised by PwC saying gold has actually outperformed stocks and bonds over the long term. So our argument has always been in our space, gold is a hedge, gold is financial insurance, it's a store of value, and it is all those things. But now there's actually research showing that gold has actually outperformed stocks and bonds over the last, it's a 10-year and a 20-year time frame. So, and then actually over a 40-year time frame. So, the lifetime of your average investor, if some prudent young man in his mid-20s starts to save for his pension today, there's probably not too many millennials doing that, but we're always advised that you should start, saving your pension early. It's and people are retiring much later. So it could be 40 years, could be the lifetime of your investment horizon, your pension horizon, So over 40 years since 1971, gold has returned 10.5% per annum, and it's outperformed stock markets and bond markets. You would think that the actuaries out there and the pension funds and all these people would suddenly be going, okay, and they're desperate for return. So I think they gradually will, but the narrative is so strong against gold that it's slow to turn. The psychology towards it is slow to turn, but I think it will turn, and I think that returns argument is quite an important one.
Yeah. So from a monetary policy point of view, there's been three key areas that you've discussed there. There's the bail-in issue. There is the fact that in a upward interest rate environment, gold actually performs well. And then the third thing there, we're talking about the quantitative easing issue and how that is continues to be very bullish for gold. So on your list of criteria to look at the gold price, monetary policy was the first one. Your second most important is?
I suppose the macro environment, whether it's inflation, deflation, stagflation.
Right.
Would probably be the next most important one, yeah. And then the geopolitics, and then the systemic is obviously very, very important, the health of the overall system,
So from the macro point of view in inflation, deflation environment, we've seen very low inflation over the last number of years. Is that set to continue? Are we actually going to start to see more of an inflationary environment? And which is more bullish for gold?
Yeah, it's a big question. The high inflation and deflation are bullish for gold. Stagflation is bullish for gold, so that's inflation and low economic growth. Benign inflation, low levels of inflation are bearish for gold, and that's what we've seen in recent years. So your previous question was, why did gold decouple from the central bank's balance sheets from 2011, and part of the reason was that it had become overvalued, and one of the key things there was in the last few months it went up 20% from 1300 to 1900 in a matter of short months. And we went on Bloomberg TV and we said this gold has become massively overvalued, and it could fall very sharply, could fall by 50%, because it had gotten very overvalued in the short term. So, that's, but at the same time, I think a lot of people are surprised that it has fallen by as much as it did, and that it stayed as low as it did for as long as it did. I think part of the reason is, coming full circle, inflation has remained relatively benign,
What's your view on inflation going forward? Are we starting to see inflationary pressures come in?
Yeah, we are, and it certainly looks like we were in the early stages of that. It's a long time coming, though, and who's to say that if you get a massive sell-off in stock markets, we could get a bout of deflation And then central banks will probably respond to that in their usual manner by printing more money, and the Federal Reserve would likely go back to printing more money, and QE would start again in the US, rather than the tapering then possibly the inflation may take off slightly later than we think, but it's very difficult to tell.
I look at it. I think there's really, really powerful arguments for inflation and deflation, and you go to central banks and they're like, we're all of our policies, they're not creating inflation at the targeted rate of 2%. This is the conversation last year, and even the last 2 or 3 years, and because they see inflation as being related to growth, and what I liken it to an elastic band that's been stretched, okay? And on one side, you have the inflationary pressures building up and pulling the elastic band one way. And on the other side, you have the deflationary pressures. On the deflation side, you have technology, feeding in price reductions on an awful lot of services and products around the world. And then on the inflationary side, you have money printing, you have employment rates falling, more people in the employment market being paid more money, moving around, chasing the same amount of products. And so these forces are pulling each other. And so I think the theory goes that once you get to full employment, the employment market then heats up quite quickly, whereas employers try to vie with each other to pay more money to those employees. And then they spend more money, and that raises the prices. And so the US just hit full employment, basically at 4.1%. We mentioned this last month. And the thinking is that that's going to really kind of transmit into inflation numbers very quickly. That means interest rates are going to go up, which means it's the end of cheap money, which means the stock market becomes very anxious about this, and that's one of the reasons it started to sell off. Was based on employment numbers, and we saw that last month. And you're seeing it in markets right across the world. European inflation rates are starting to rise. The UK is far ahead of everyone else. I think it's over 3% now, and it's rising much faster than they thought. And so, the stage is set for higher inflation rates, thereby higher interest rates, and more risk when it comes to debt burdens in the future. Right. So that's where we are. And that elastic band is stretched in favor of inflation.
I like that. I like that analogy.
Yeah, it's a good one.
So let's touch then on the geopolitical issue. I mean, we've seen an awful lot of increase in geopolitical tension particularly over the last 12 months. How is that going to now start factoring into the gold price?
Well, I think it's surprised people that it hasn't factored in as much, but I suppose there's been a lot of sabre-rattling and a lot of threats, and there hasn't been any, thankfully there hasn't been any, war hasn't broken out.
Well, not in the West, but in other parts of the world, yeah.
Well, yeah, I'm talking obviously in terms of the US and North Korea primarily, which has been the big sort of geopolitical threat of war. But yeah, there are proxy wars, and obviously in recent days we see what's happening in Syria, and so there is. Yeah, I mean, the Middle East is massively destabilized and has been for a long period of time, but it looks more destabilized now than you've seen in a long time, and it's getting to the stage now where you can very much see the parties aligning against each other in terms of in Syria now, and with Turkey seem to be allying themselves with the Russians, and the Chinese in the background seems to be quietly supporting the Chinese and Turkey, and then there's obviously the Israeli and the Americans, and so I don't know. I think it's one of the most uncertain. My background is history. I mean, you study history. You see these things, and I think it's as uncertain as it's been in a long, long time. And it looks like we're building up to quite a significant, major military confrontation, between some world powers, particularly Russia. And you see the demonization of Russia, and the Russians have done lots of naughty things that they shouldn't be doing. But the dialogue is. It's not about dialogue. There's no one sort of saying, well, we should sit down and talk to these people, as was seen after the Cold War. We realize it's not good to demonize nuclear powers, and we should all sit down and, de-escalate and decommission arms, and, the whole nuclear arms race. People realize that's not a good thing. But we have a lot of hawks, neoconservatives in the States, and the Pentagon is quite hawkish. And they see Russia as an emerging power, and they don't want the Russians to emerge to the power, and they're trying to keep them down. And then you have Trump come in, and he's
the great antagonist.
yeah, he's crazy, and he's a perfect fall guy, and he can be manipulated to do anything, and he's doing all sorts of things that are creating huge instability in the world, and just even the everything is a military. It's always an aggressive response. It's never a sort of a step back. Even we were talking briefly before about the tragic police shooting in Florida, and the issues with gun control in the States, and the response from Trump is, we need to arm the teachers, and it's just crazy stuff. Everything is like aggressive.
Well, at least he did say we don't need to arm the students. I mean,
that's the next step. Yeah.
If I could come in there, I look at the geopolitical backdrop, and what I see is a lot of sabre-rattling, as Mark just said. But I do think we have is a generation of leadership who has forgotten what the cost of war is, and how you have to fight for peace. And you have to always be on guard. You have to maintain diplomacy. You have to have those institutions of diplomacy. And you're seeing the United Nations being attacked all the time. It's losing power. Nationalist agendas are becoming back into vogue, and I think that's happening. Again, to harp back to the same theme. I think that's happening because it's an easy answer. It's an easy drum to beat nationally, to blame a bogeyman for the woes of the people, because you're deflecting from yourself. You're deflecting from the inherent weaknesses in our systems, which is a big down to monetary policies and the thieving that's going on there. And you're able to point to somebody else. You're saying, hey, it's not us. It's not us that are destroying your livelihoods and giving you no security in your employment. And you haven't had a pay rise in 30 years. This is the average American worker. It's the Russians. It's the Chinese. It's the
Mexicans.
Al Qaeda.
Build a wall.
Yeah, it's the Mexicans. I mean, let's blame anybody but ourselves. So we not because it's not because that they feel it's their fault. It's that they don't have any responses. They don't have a plan, a strategy to deal with this. They're just going to and it's like Goebbels. Like this is straight from the book. World War II Goebbels. You make a bogeyman. You blame him. You distract people from it, and then you maintain control. Eventually, it ends in tears. And it's going. I don't know how this is going to work itself out, but you're seeing it right across the world. And right now, you have the disintegration of NATO. You have Turkey going off-piste, invading countries, taking on military equipment from, not from the NATO countries, but from Russia and places like that. Same with Egypt. So the old alliances are breaking down. This is not necessarily in Russia's interest. So they probably will argue it is. This is a void of leadership from the US stepping back. And the United Nations not able to assert itself, and a generation of people who have forgotten what the cost of war is and how important peace is.
Yeah, I agree in a very large part. Absolutely. Yeah, this is a quotation from Hemingway, which sort of sums it up, and I'll paraphrase him because I don't know the exact quotation, but it's the first panacea of a mismanaged country is inflation, and the second is war. And both bring a temporary prosperity, but both bring permanent ruin. And that's war is massively costly and massively destructive, And I mean, Trump is just
very, very pertinent in this time.
Yeah, absolutely, because we've been talking about inflation, and now we're talking about the geopolitics and the risks of both terrorism and war, and it's just very, very costly to society. And the US had $1 trillion deficits for a long number of years now, and Trump $1 trillion deficit is getting even bigger. I think the number came out recently, 1.15 trillion they're projecting now, and a large chunk of that is on military budgets. They're absolutely massive, and it's hugely destructive to nations and especially in the global economy, because we've made such progress in recent years towards globalization and free trade and all these multilateral institutions, whether the United Nations, the trade agreements we have, it's lifted a lot of the world out of poverty. There's huge issues with corporatism as well, and and inequality, but we have made progress. And unfortunately, I think that progress is at risk.
Well, I think it's actually one of the major faults lies with the media. They are the protectors of democracy. They're supposed to hold these people to account. They're supposed to question. They have become partisan. They have become tribal. They have aligned themselves politically, and very outwardly and unapologetically. But the cost of that alignment politically is they get access to information, but only the information that's required to sell the story. They no longer question politicians. They no longer question policy. And we, the people, are left, holding this risk. And I think they've completely and utterly let us down in that regard.
So let's just bring it back to the topic at hand and the price of gold. How does this specifically drive the gold price higher?
I suppose it's risk trade, it's risk off, it's safe haven demand. You've seen it throughout history, and there's James Steele in HSBC. He's one of the better gold analysts out there. He did a great piece about war and gold there recently, and just how gold does well during war, and has done throughout history. And you can see it even, more
it is that
in the 1970s.
Hedge against uncertainty.
Yeah, exactly. I mean, the 1970s, the gold price went up so significantly, and it was partly due to the US had been massively spending a huge amount of money during the Cold War and then the Vietnamese War. Also, President Johnson had was it the Great Society, the Big Society, whatever that program was called, which is a big sort of, tax and spend sort of social welfare. And there was some good stuff there, but they were spending a lot of money in terms of the military side as well. And it was very costly. And people began to question the value of the dollar. And Charles de Gaulle, the French president, said, we're not trusting it, and he put his money where his mouth was, and they demanded the return of their gold reserve, so they sold the dollar and took back gold in effect, and that, that's just a sovereign example of what happened. People became concerned about the dollar and began to buy gold. So when you have the US is probably, the greatest superpower the world has ever seen. And we're moving to a multipolar world, but there are elements in the US, upper echelons, shall we say, in the deep state, who are desperately trying to hang on to power, and you can see it very clearly. 19th century was the British century, 20th century was the American century. The 21st century is going to be a multipolar century. Some people say Chinese century. I'm not so sure. Some people say Asian century. I think Asia is going to be very, very powerful, just given demographics, the lack of debt, and a whole variety of other reasons. But we are moving to a multipolar world, and Asia will be very powerful in that thing. And so to me, that's the big picture geopolitical thing that's happening, and it means that the dollar as a reserve currency of the world is very, very vulnerable. If you look at the reserve currencies, they tend to have a lifespan of about 70, 80 years. So you can see Portugal in the 15th century had it for 70, 80 years, then Spain, then Holland, then France, then the UK, and more recent the US. And the US has had it since, after World War I, in effect, pretty much, 1920s. It's hard to know pinpoint the exact year that the US took over from sterling, when the dollar took over from sterling as the reserve currency. But it's, you could say it's roughly sometime in the 1920s.
Just so we try and cover off as many angles here as possible, let's just briefly talk about the underlying fundamentals of gold, the supply and demand fundamentals. Particularly, let's start with the supply side. What are the issues there that you see that underpin a gold price heading towards $10,000?
Well, everyone talks about the demand side, and all the focus on the market tends to be the demand side, and it's hugely important, obviously. But the supply side is as important, and we are at peak gold. The production of gold is peaking increasingly. It's something we've looked at for a long number of years. Increasingly, a lot of analysts are accepting that. Even Goldman Sachs recently came out with a report talking about peak gold. So just for the listeners, peak gold is, we're not going to run out of gold anytime soon. There's still not a huge amount of gold in the Earth's crust, but there is gold in the Earth's crust. The supply increases roughly about 1.5% per annum, 2% per annum. But the supply is actually decreasing. We haven't found any major gold mines for a long period of time. And
it's getting increasingly more expensive to extract it. Yeah, so all the easy to be found gold has been found. So it's a case of digging deeper.
Going to the moon with Elon Musk.
Exactly. That's the narrative of the gold bears. It's one of the few sort of arguments I see why gold prices won't go higher. Gold prices are going to go lower because we're going to find a huge amount of gold on Mars or on some other planet. It's like, we can't get it out of the ground in South Africa. Well, we can't get it out of the ground in these nations. We're having to go deeper and deeper. And as you said, it's hugely costly to do it. on this planet, in this atmosphere where we breathe oxygen. Can you imagine the cost of trying to get an ounce of gold off another planet?
Ship it
we
back.
can't get a man back on the moon. How are we going to get men up there mining it? Come on, give me a break.
We never went to the moon. I jest. Now, but even if you look at mine supply, I think it's 1.6. What you said, between 1 and 2%, it's like 1.6% per annum, and then demand has grown by 18% since 2001 every single year.
Wow.
I
mean, it's off the charts.
And where is that increase in demand primarily coming from?
China.
Primarily,
that's a big factor.
Yeah, China, India was the story maybe last year before, but now Germany has become the number one demand market in the world.
Yeah, and really, it's a good point. China, I mean, the Chinese gold market was liberalized in 2003. So, and from 1950 to 2003, Chairman Mao actually banned gold ownership in 1950, and the Chinese people couldn't actually own gold for more than 50 years, So the per capita consumption of these 1.3 billion people is increasing from a near zero base. So that's a really long-term structural thing that's been happening since 2003, and it continues today, Now, but the German thing is a more recent phenomenon, and I think that's very interesting because it's born of the euro, and the Germans realize that they share a currency with Italians and Spanish and Greeks and Irish and people who are not as prudent as them, and they're very, very worried about it, and they're beginning to diversify into gold, But meanwhile, the Spanish and the Irish and the Portuguese aren't buying gold because they think they have the German money, they have the euro and they're sorted, and they don't realize the risks. It's a funny dichotomy that's going on there, But the Germans realize the risks, but we think we have their currency, so we're grand, and we don't need to diversify into gold.
And that demand, I mean, is that primarily investment demand now? I mean, obviously gold is heavily used in electronics and also in certain cultures. Jewellery is very important in gold form. But do you think this 18%?
Well, it's very broad based, and that's the thing. That's why gold is so supported. The price is so supported because there's so many different drivers of demand. Jewellery is huge, particularly in Asia, obviously in China and India, and people buy gold as a store of value there and in the Middle East. But investment demand, I think, is the one that will ultimately drive it, and that's what drove it in 2011. ETF demand and coin and bar demand, and that's where the demand in Germany is coming from. But also in Asia, the more sophisticated investors in India and China are moving more to coins and bars.
And when people hear about the demand for gold for jewellery, particularly in certain Asian cultures, that's really, it's not as an adornment. It's not as something pretty to wear. It's culturally that the jewellery is not as crafted, let's say, but it's as a store of value. It's worn or kept as heirlooms or as an investment, as a store of value, rather than as a...
Primarily. I mean, it is a bit adornment as well. I mean, I've been in Mumbai and been around India, and I've seen the Indian women wearing their gold, and, they look amazing, and it's a beautiful thing, and so there is a little bit of that going on, but it's primarily as a store of value. It's a savings vehicle, and it's part of the dowries, and it's been there throughout their history, and it doesn't look like it's changing anytime soon.
Well, I mean, I can speak to demand that we see on a daily basis, and obviously we're well known for our storage programs in gold. I know that sounds like a shameless plug, but that's why people come to us, and because we offer segregated allocated gold, whereas most people don't. So we have clients who are coming to us, and interesting, just in the last 6 months.
So just you talked about the segregated allocated gold. We probably don't have time to go into that at the moment, but that's probably definitely something we should cover off in a podcast.
Yeah. All gold is not equal.
Right.
It's how you hold it, and most people hold gold in exchange traded funds. And we'll talk about it another time, but they would have some serious structural issues about them, especially when it comes to certain economic scenarios. So a lot of our clients would come to us because of the segregated allocated nature. So I have clients who just recently, two particular clients who are going into retirement, and they are moving a significant sum of their cash reserves and some of their hard assets, like in property, and putting into gold, physical gold, which they just intend to sell off to live for the next 10, 20, 30 years. And they're going to sell off a portion every year and raise cash and pay their bills and go through life. They see that as a retirement nest egg. They don't want to have exposure to the equity markets, bond markets, or the banks. They just want their gold literally waiting in a segregated vault.
They see it as cash. It's money.
They see it as money. Yeah. You know what? If the price goes down a little bit, it doesn't really bother them. If it goes up, hey, that's a good day. They're just going to be able to take a little bit of money every single month and sell a bit of gold and raise that cash to live off, and that's their future. And we have about two very large clients doing that just in the last few weeks, and we're seeing it as a trend emerging as well.
Just on the demand side, talk to me about central bank demand. What are we seeing in central bank demand?
It's high, but it could go a lot higher given the scale of the foreign exchange reserves that are out there. But basically, I think it's roughly 400 metric tons per year. So it's chunky. I mean, just today, big breaking news overnight: the Russians bought another 18.7 metric tons in January, which is 600,000 troy ounces, which is quite a lot for the Russians. The Russians tend to buy 300,000, 400,000 ounces per month.
More than the Chinese now, isn't it?
Yeah, and the overall, that's exactly it. Yeah. So the Russians have now surpassed the Chinese in terms of their gold reserves. I think they're the sixth largest in the world. So the US would be number one.
But I saw in your piece today, the Turks, where the Russians brought 16 tons, the Turks have bought 204 tons. Was it last year or something?
Yeah, I think 13 months. Yeah.
That's incredible.
That's a lot. Yeah.
That is them disengaging from NATO, looking to protect themselves and in a changing world, in a multipolar world, that they're getting ready for a multipolar geopolitical backdrop.
Absolutely, and they're encouraging their citizens to buy gold as well, a bit like the Chinese have done as well. I think they realise, these geopolitical tensions are soon to erupt, and I think it's going to lead to a currency war scenario at some stage, and this is a symptom of it. I mean,
if you're Turkey, up until now, you would have had your backstop was the £100 gorilla. The United States, who will come to your aid via NATO and protect you in all situations. They don't believe that anymore, and now they're saying, we need to protect ourselves in every way we can. So
this is a long-term structural thing, because a lot of these countries have quite low gold reserves vis-a-vis their foreign exchange reserves. So it's a very strong trend that's set to continue, and it could actually accelerate. I mean, that Russian buying just this month it's increased quite significantly. And if the tensions decrease as we've seen recently, increase, should I say, then I think that gold buying will increase, and the Chinese have stopped buying US treasuries as well. The Chinese have stopped reporting their gold buying, and the Chinese can be quiet for a number of months, and then they make a big announcement, and they suddenly go from 1,000 metric tons to 2,000 metric tons, and we could see a big leap forward in the Chinese gold reserves as well in the coming weeks and months. So it's a strong fundamental support on the gold market, and a factor that should drive gold prices much higher in the coming months and years.
It's funny. At home, I have three young kids, and you're always chastising them and giving them advice on what to do, and telling them to behave themselves. And sometimes they promise everything. They say, "Yeah, absolutely, I'm going to behave, Dad. I'm going to do exactly what you say. No problem. I'll follow the schedule." And then I turn around to them and I say, it's not what you say; it's what you do that counts. And in this case, looking at Turkey, it's and all these markets around the world, it's not what they say. They're just saying everything to appease people. But watch what they do. If they're buying gold, they're doing so because they have good reason. They want to protect themselves from an uncertain future.
Yeah, absolutely. And the US still has over 8,100 metric tons and hasn't sold 1 ounce. Wow. So
the Germans brought it back. The Germans brought it back. They brought it back into their own storage. Why would you suddenly take your gold back from, again, Europe, the £100 gorilla, to the US? Because they have issues in terms of trust.
Absolutely, yeah.
I have to challenge you here, gents, because we've looked at this from a macro point of view. We've looked at it from a geopolitics point of view, from a monetary policy point of view, from a supply and demand point of view. And on every one of those, you're seeing all of these factors as being bullish for the gold price. What's the banana skin for the gold price? What if we're sitting here in 2 years' time or 3 years' time and we're still looking at gold at the same level? What has to have happened in the world for that to happen?
Elon Musk mines gold on the moon. I think the biggest risk would be if the banks, central banks and officials realize that everything we've talked about is completely unsustainable. And they realize that the primary solution to this is massive debt forgiveness and debt write-downs and some form of debt jubilee. That potentially is a banana skin for the gold price, because that's me primary one. If peace broke out in the world and suddenly all these competing nations and China and Russia and America decided, guys, this is crazy, we're going to potentially annihilate each other here, or we're at least going to badly damage our economies. Why don't we sit down and work together and come to some sort of solution? Let's have a big, as we had Stalin and Churchill and who was it? Roosevelt sat down. So we need to get these guys into a room and they need to sort these things out. But unfortunately, that doesn't look like it's going to happen anytime soon. Yeah.
I have one theory, and it's slightly on the conspiracy side, but the only reason gold will stay where it is because the price is repressed. And they continue to print money to sell the narrative. You have a media that goes along with this and doesn't question it and keeps people in ignorant of the facts, and they sell the gold price as it rises, and they do so with printed money through their proxy banks and private equity firms, and they keep this narrative going for a long time.
Yeah, no, I agree with that. Sorry, and that's the key thing. And I meant to get to it earlier on when you asked why did the gold price fall as much as it did, given the factors in terms of central banks still printing money. I think part of the reason was manipulation, and there's a huge amount of evidence that the gold price has been manipulated, as all assets are today. That's what quantitative easing is. They're printing money to buy bonds, to push up the price of bonds and push down the yields.
Who was that chap on the TV the other day? He was a big Wall Street head, and he turned around on mainstream TV and said, 1/3 of all financial assets now are owned by governments. They 1/3. And he kind of just said it and it was a pause, and then the 2 or 3 anchors that were there in the room with him interviewing him kind of just moved on.
Moving swiftly on. Nothing to see here.
It was like, wait, stop! Did you not just hear what he just said? Yeah.
We might flesh that one out. But that is a risk. But I think that's been the risk in recent years, and I think ultimately the forces of supply and demand will overcome that manipulation. And I think that was seen, from the 2011 period. I think ultimately the people who are manipulating the gold price will realise this price is going higher, and they'll have to retreat to higher ground, so to speak. But to expand it, and sometimes I think my little conspiracy theory for today is that sometimes I think that a lot of people talk about digital gold and cryptocurrencies and Bitcoin, and this is the big threat to gold, and I don't think it is. I think it's actually quite complementary. I think what's happening in the cryptocurrency space is actually it's highlighting the vulnerability of the fiat currencies and of the banking system and all the rest.
And the frustration people have.
Yeah, exactly. And I think it will be very good for gold and silver in the medium and long term. But in the short term, I think it creates a risk because who knows? You might get people who would have ordinarily migrated into buying gold and silver, buying cryptocurrencies instead. So in the Western markets, I think it may, and my conspiracy theory is some officialdom in that they want to push some capital into the cryptocurrency market rather than into the gold and silver market.
Right. Okay. And Steve, as you said, not all gold is equal. And I think that actually might be a title for our upcoming podcast. But I think that's a good place for us to leave it for today. Gents, I want to say thank you once again. It's been fantastic and extremely informative. I hope everybody that's listening to this podcast has felt the same way. And what we want you to do is to comment and share this podcast to people who are going to be interested in it. Send us comments about what you'd like us to talk about in future podcasts. Remember, you can subscribe on iTunes, on YouTube, and on SoundCloud. And you can actually sign up for our market update at GoldCore.com. Follow us on Facebook. Follow us on Twitter. But from me, Dave Russell, Mark, Steve, thank you all very much.
Yeah, thanks, guys. And if you have any questions at all, just put it down on the YouTube channel as well, and we'll address them in coming webinars.
Yeah, thank you so much for listening in today.
Thanks, guys.
Cheers. You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed.